this presentation, I will discuss the current state of impact investing in fintech. First, let me briefly explain these two concepts. Impact investing is an investment strategy that aims to generate both financial returns and positive social or environmental impact. Fintech, which stands for financial technology, refers to the use of technology to improve financial services such as digital banking, online payments, lending, and investment platforms. When these two concepts are combined, they create opportunities to improve financial inclusion, support sustainable innovation, and generate long-term value for both investors and society. Today, I will explain the current market, the main developments in fintech, and the key challenges identified in the literature. And let's move to what is impact investing. And before looking at the market, it is important to understand what makes impact investing different from other investment strategies. Unlike traditional investing, as you can see here in the table, which mainly focuses on financial returns, impact investing has two objectives. It aims to achieve competitive financial performance while also creating measurable social and environmental benefits. Although ESG investing also considers sustainability, it mainly evaluates environmental, social, and governance factors to reduce investment risk. Impact investing goes one step further because creating positive impact is an intentional part of investment decision. Three characteristics define impact investing: intentionality, measurable impact, and financial returns. These characteristics make impact investing increasingly attractive for investors who want to create value beyond profit. Fintech has transformed the financial services industry by making financial products faster, more accessible, and more efficient. Today, the industry includes several important sectors such as digital payments, digital banking, lending, wealth tech, regtech, and insurtech. Many of these innovations help people and small businesses gain access to financial services that were previously unavailable. The market has grown rapidly over the last decade. According to the Global Impact Investing Network, the global impact investing market reached approximately $1.57 trillion US in assets under management. At the same time, fintech market continues to expand due to technological innovation, artificial intelligence, digital banking, and mobile payment solutions. These developments demonstrate that investors increasingly recognize the potential of combining financial returns with measurable social impact. The literature generally agrees that fintech has created significant benefits for both society and financial sector. Many researchers highlight that fintech improves financial inclusion, increases accessibility to financial services, and encourages innovation. However, the literature also identifies several important challenges. The first challenge is regulatory uncertainty, as different countries apply different financial regulations. Another challenge is cybersecurity, because financial services are becoming more digital. Protecting sensitive customer data has become increasingly important. Researchers also discuss the ethical use of artificial intelligence. AI can improve financial decision making, but biased algorithms may lead to unfair outcomes. Another issue is greenwashing, where companies overstate their environmental or social impact without sufficient evidence. Finally, measuring impact remains difficult because there is still no single global standard for evaluating social and environmental outcomes. These challenges show that although impact investing in fintech has enormous potential, responsible governance and transparent reporting remain essential. To conclude everything, impact investing in fintech has become an important part of the global financial sector. It combines technological innovation with measurable social and environmental impact while still aiming to generate financial returns. The market continues to grow rapidly, supported by increasing investor interest and ongoing digital transformation. However, challenges such as regulation, cybersecurity, AI ethics, and impact measurement must continue to be addressed to ensure sustainable long-term growth. Understanding the current state of the industry provides a strong foundation for identifying future opportunities, which will be discussed in the next part of our presentation from my colleague.
Good afternoon, everyone. In this part of our presentation, I will discuss the future opportunities for impact investing in fintech. So, as financial technologies continue to transform the global financial system, they create opportunities not only for financial returns but also for generating positive social and environmental impact. And in this section, I will focus on the main investment themes that are expected to shape the future of the fintech industry. Before looking at specific technologies, it is important to understand why fintech has become one of the most attractive areas for impact investing. So, fintech combines technological innovation with solutions to major global challenges such as financial exclusion, climate change, and access to digital financial services. And based on our research, four major themes stand out as the strongest long term investment opportunities. And they are financial inclusion, climate fintech, artificial intelligence, and digital infrastructure. Together, these trends combine innovation, measurable impact, and strong long term market growth. These opportunities are closely connected rather than existing separately. Financial inclusion relies on digital infrastructure. Artificial intelligence improves efficiency, risk management, and customer service. Climate fintech supports sustainable finance and ESG objectives. And finally, emerging markets provide the fastest growing environments where these technologies can create the greatest economy and social impact. The first major opportunity is financial inclusion. Although access to financial services such as improved significantly, more than 1 billion adults worldwide still remain financially excluded. Fintech is helping to address this challenge through mobile banking, digital wallets, fintech lending, and embedded finance. Successful examples include M-Pesa in Kenya, Paytm in India, and Mercado Libre in Latin America, all of which have expanded access to digital financial services. And as digital banking continues to grow, financial inclusion is expected to remain one of the strongest long-term opportunities in impact investing. The second opportunity is climate fintech, which supports sustainable finance through ESG solutions, green finance, carbon finance, and climate risk management. And as sustainability becomes a global priority, demand for these technologies is expected to continue growing. Another major opportunity is artificial intelligence. AI is transforming financial services by improving fraud detection, credit scoring, automation, customer service, and risk management. Despite challenges such as cyber security and data privacy, AI is expected to remain one of the most main drivers for future fintech innovation. Another important investment theme is digital financial infrastructure. It provides a technological foundation that enables modern financial services to operate efficiently and securely. Key components include payments, infrastructure, cloud banking, banking as a service, APIs, and digital identity. Together, these technologies make financial services faster, more connected, more accessible, while also supporting innovation across the entire fintech ecosystem. As digital transformation continues, investment in financial infrastructure is expected to remain essential for future growth. Let's now look at where these opportunities are developing most rapidly around the world. Africa leads in mobile money. India has developed one of the world's most advanced digital payment systems through UPI. Latin America is expanding digital payments and lending, while Central Asia and Southeast Asia continue to grow digital banking, embedded finance, and e-commerce. Together, they are expected to remain key drivers of future fintech growth. This table summarizes the main findings from our analysis. Overall, all of our investment teams demonstrate strong long-term potential. Financial inclusion and climate fintech generate the greatest social impact, while AI offers the strongest technological growth. Digital financial infrastructure provides the foundation that enables innovation across the entire fintech ecosystem. So, overall, our research shows that impact investing in fintech can combine competitive financial returns with measurable social and environmental impact. To conclude, our research shows that fintech has the potential to generate both competitive financial returns and meaningful social impact. The opportunities we discussed today provide a strong foundation for future impact investment strategies. And in the next part of our presentation, my colleague will explain how these opportunities are translated into diversified fintech impact investment portfolio. Thank you for your attention.
So my name is Minjong Kim, and I'm gonna present part 3, which is portfolio structure and financial return. Based on the industry analysis and investment opportunities identified in part 1 and 2, my responsibility was to construct an investment portfolio that balances long-term financial returns with measurable social and environmental impact. In this section, I will explain how the portfolio was built, why these investments were selected, and how the portfolio manages both return and risks. So the portfolio follows a structured investment process. After analyzing the impact investing industry and identifying future opportunities, we developed a portfolio designed to capture long-term growth while supporting positive impact. Rather than focusing on short-term market movements, the portfolio targets long-term trends that are expected to shape the future of financial services. And the portfolio is built around 4 investment principles. And the 4 principles guided the portfolio construction. The firstly, sustainable growth by selecting companies with scalable business models and strong long-term potential. The second one is measurable impact through investments that improve financial inclusion, digital innovation, and sustainable development. Third one is diversification across sectors, regions, and asset classes to reduce concentration risk. And lastly, the sustainability alignment ensures the portfolio remains consistent with the principles of impact investing. So based on these principles, the portfolio is allocated across 8 investments. The core holdings are Adyen, Mercado Libre, Kaspi, and Wise, which provide exposure to key fintech themes such as digital payments, financial inclusion, digital banking, and cross-border payments. The portfolio also includes Schneider Electric and Fiserv as supporting holdings. Although Schneider Electric is not a pure fintech company, it broadens sector diversification by providing sustainable digital infrastructure, while Fiserv strengthens exposure to financial infrastructure. Finally, FINX, which is Global Fintech ETF, increases diversification across the fintech industry, and BGRN, which is iShares US Dollar Green Bond ETF, improves portfolio stability through investment-grade green bonds. So diversification was one of the key considerations during portfolio construction. Geographically, the portfolio is diversified across Europe, North America, Latin America, and Central Asia, reducing dependence on a single market. It is also diversified across several investment themes, including financial inclusion, digital payments, digital financial infrastructure, and climate technology. Finally, diversification is achieved through different asset classes by combining individual companies with a thematic ETF and a green bond ETF. This approach reduces concentration risks while maintaining exposure to multiple long-term growth opportunities. So while the portfolio focuses on long-term growth, managing risk was equally important. The primary growth driver are at the end Mercado Libre, Kaspi, and Wise. And for example, at the end achieved 18% revenue growth and 53% of EBITDA margin in 2025, demonstrating strong financial performance. And Schneider Electronic and Fiserv strengthen the portfolio through digital and financial infrastructure while improving sector diversification. The FINX ETF reduces company-specific risk through diversified exposure to global fintech companies. Meanwhile, the BGRN ETF holds more than 300 investment-grade green bonds with a 4.71% SEC yield, providing additional portfolio stability. Together, these investments create a balanced risk-return portfolio that supports both the long-term growth and measurable impact. So in conclusion, the proposed portfolio successfully combines financial performance with the principles of impact investing. By investing in companies that promote financial inclusion, digital innovation, sustainable infrastructure, and responsible finance, the portfolio captures multiple long-term growth opportunities while maintaining diversification and effective risk management. Rather than relying on a single company or sector, the portfolio combines high-growth fintech leaders with supporting infrastructure, diversified investment vehicles, and investment-grade green bonds to improve resilience across different market conditions. Therefore, we believe this portfolio is well-positioned to deliver sustainable long-term growth while creating meaningful social and environmental impact. Thank you.
Good afternoon. My name is Hadi Saigan, and today we are going to be looking at part 4 of our investment portfolio. Part 3, the most recent one, had explained what we should invest in. My section will now explain how we evaluate whether that investment is actually successful. This part builds upon the portfolio structure. My section focuses mainly on how investors can measure whether the portfolio is successful, what risks need to be managed, and whether the portfolio should be recommended or it shouldn't. So the first area we're going to consider for this is risks and challenges. Because the portfolio is strongly exposed to growth-oriented fintech companies, there will be large market volatility that are faced by those companies. Like I said, short-term volatility is expected. Regulation is also a very important part of this, as payments, lending, banking infrastructure, and other digital finances are heavily regulated sectors, so different regulations could differently impact our portfolio. Furthermore, the most important one that we're facing here is cybersecurity and data privacy, as those companies process large amounts of financial customer data, and that can be leaked or the hackers could infiltrate, and therefore that is a very large risk that we are looking at here. Another one is greenwashing and obviously impact washing. This is important as investors must consider this. So to say, companies might over-exaggerate their sustainability or their social impact. And then we also have geographical and cultural impact, currency impact due to different exchange rates and the impact that those may have. So secondly, we're going to be looking at environmental, social, and governance, which is ESG, versus impact measurement. The measurement frameworks used are the GIIN, IRIS+, the Impact Frontiers Sustainable Development Goals, and another one that is more to that in the portfolio itself. They're all explained there. Now to look at the analysis of the ESGs. What were important to separate them from impact, obviously, because looking at how responsible companies operate through governance or through data privacy or compliance and environmental practices, the impact measurement differentiates from those, because the impact is the real world impact those actually create, which could be positive or negative, and in our case, hopefully positive. And that goes a lot further than the goals, because it's what effectively gets created. The main impact areas that we have are financial inclusion, digital marketing infrastructure, and climate impact, lower cost payments. That is why frameworks like mentioned are so important, as these give different dimensions of the impact themselves, and sustainability reporting standards are useful to measure our ESG goals. So next, I have compiled a list of KPIs to judge whether the portfolio is successful, since investors need both financial and impact KPIs. I will briefly run through all three sections that we have here. The individual KPIs are listed on the slide itself and furthermore in the report. And we have financial KPIs to show whether the portfolio creates advanced or attractive returns compared to its risk. We have social impact KPIs, which measure whether companies that we are researching, such as Kaspi.kz, Mercado Libre, Wise, Aiden, and Fiserv, are expanding access to digital financial services to see what their impact, their social impact is positive. And then we have governance, environmental and governance KPIs, which are especially relevant for Schneider Electric and Green Bond ETF. While companies rely heavily on trust, building a sense of security and compliance will definitely allow for more trustworthiness and for further investment in the future, making it a more attractive long-term investment. Now, in regard to monitoring our impact processes and about how impact should be monitored, we heavily believe that impact should not only be measured once, it needs to be monitored regularly. Investors should collect data from annual reports, sustainability reports, ETF fact sheets, and they should compare their portfolios against the chosen KPIs to see how we stand. The portfolio should afterwards also be alignment checked with the sustainable development goals, which are the SDGs 8, 9, 10, and 13, which we mentioned more about in our report itself. Especially economic growth, innovation, and infrastructure, and whatever reduces inequalities in climate action. And if a company no longer fits our financial profile or impact objectives, the portfolio should be rebalanced completely, removing the weak link out of the equation, or rebalancing it, or reducing the concentration of said weak link to make sure that our impact objectives are actually being met the way we want them to be met. So in regard to what investors we are recommending this portfolio to, we are looking for investors who are seeking a long-term investment and have a medium to high risk tolerance. This should not be seen as a short-term trading portfolio at all, because the main themes such as financial inclusion, digital payments, AI, climate technology, and digital infrastructure develop over several years, so this will take a lot longer for gains to be shown the way they are, with a lot of risk in the meantime. Investors should rebalance at least once a year to make sure that our impact stays aligned, and monitor ESG controversies, cybersecurity incidents, and greenwashing risks. This will filter out the good from the bad and keep us straight line the way we want to go. I also believe that the green bond allocation should be kept, because it provides stability and strengthens the environmental impact of the portfolio by quite a margin. Finally, to look at the final recommendations of our portfolio as a whole, not just to investors, but in the grander scheme of things. We just talked about what type of investors we look for, what they should do, what their return logic should be. But from an impact perspective, the portfolio is aligned with, financial inclusion, lower cost of digital payments, and green bond financing and infrastructure. Those things are very important in terms of our long-term return potential. However, the recommendation depends on active monitoring and how well certain aspects of the portfolio can be filtered out if they perform or don't perform the way that we hope they do. Yeah, so my final recommendation is positive, but it's quite conditional. The portfolio is recommended as a long-term impact investment strategy as long as investors measure out both financial performance and impact outcomes over time through either our KPIs, through mainly what we've discussed here in the end, saying KPIs for like measuring our ESG and our impact scores versus our KPIs to see really if what we're doing is going well and if it should be filtered or not. Thank you for... And with that, I would like to thank you for taking the time to listen to our presentation and to have read our portfolio in regard to impact investing.